Good afternoon. My name is Beverly Reyes, and I'm a partner here in the corporate group at Baker Botts, and I advise clients on the preparation of reports under the Exchange Act, including proxy statements and executive compensation. So it seems that now would be a timely point in the early part of this proxy season to start talking about pay ratio disclosures, which is a new disclosure that we'll be covering in proxy statements and 10Ks this year. Before we get into the meat of the presentation, just wanted to get a couple of housekeeping matters out of the way. If you have any questions during the presentation, please email them to Susanna Kamaj, and we will answer them during the Q&A session following the presentation. If you are seeking CLE credit, we will announce the code for the CLE credit at the end of the presentation. Please include this code on the information form, which you can download in the reminder email which was sent to you yesterday. If you do not have this form, please email Susanna at the email address provided, and we will get you a copy of that affirmation form. We'll leave this slide up just so you can get the email address written down in case you have any questions as we move forward, and then we'll get started. Okay, so let's talk about the pay ratio rules. For those of us who were hoping that the pay ratio disclosures, which were originally mandated by the Dodd-Frank Act of 2010, would go away. Unfortunately, they are here to stay for now. The final rule was adopted in August 2015 after the usual proposing release and comment process. And we've gotten some interpretations and guidance from the SEC along the way. And there may have been a point in time, or I suppose you could say several months, where we had hoped that the rule would either be repealed by the SEC or perhaps we would see legislation get signed into law where perhaps the rule itself would be repealed by statute. Unfortunately, that was not the case. As late as September 2017, the Financial Choice Act was working its way through the Senate, and it would have included a provision that would have repealed the pay ratio disclosures, but sadly for us, it did not come into law, and the SEC back in September had confirmed that it is full speed ahead with the pay ratio rule. They weren't going to repeal it or delay the first pay ratio disclosures. And in fact, they issued guidance in September 2017 that would allow companies to exercise a little more discretion. It gives them greater flexibility to determine the median employee compensation. So what does the pay ratio rule require? It requires a company to disclose its annual total CEO compensation, as it does every year when it prepares its summary compensation table, and to compare that total CEO compensation to the annual total median employee compensation for the last completed fiscal year. And so when we're talking annual total compensation, we're talking about total compensation reported in the summary compensation table. That's for both the CEO and for the median employee that the company ultimately identifies. There's a process that we have picked up or gleaned from the SEC's rules as far as how to identify the median employee and to calculate that person's total compensation. The first step would be to pick a determination date within 90 days of your company's fiscal year end to identify any employees of the company and its consolidated subsidiaries. So for those companies where perhaps they are more likely to have seasonal employees in December who may have lower compensation because they're only providing services to the company for perhaps a limited amount of time during the holidays. If you were to pick a determination date of November 30th, you would not have to include those seasonal employees who are hired and working for you during December for the holidays. So that's one nice bit of flexibility that we got from the SEC after its comment process that ultimately made its way into the final rule. Another item that I wanted to point out in this step is that it does include employees of the company and its consolidated subsidiaries. So if you're working with a client, let's say, who has, they have a significant investment in another company, what you may hear your accountants call equity method affiliates. Maybe you own a minority percentage in the company, such as maybe 20%, so not enough to actually consolidate that other company as a subsidiary, but enough that it has an impact on your financial statements. Those companies where you're treating them as equity method affiliates, you don't need to include their employees in your company's, or rather your client's global employee workforce. You can exclude those companies from that company's employees from your pay ratio calculation. Other companies that would not count as a consolidated subsidiary are entities where you're dealing with joint ventures. And the SEC's reason for limiting the focus for the pay ratio to employees of the company and consolidated subsidiaries and allowing companies to exclude employees at equity method affiliates and joint ventures is the thought was that the company and its compensation committee would have more control over how the compensation is determined and paid out at its own company and at its subsidiaries rather than some of these other companies like equity method affiliates. So this brings us to the next step of identifying who your median employee is, and that is building a profile of your U.S. and non-U.S. employees who are identified as of the determination date. So those are your employees who were employed by the company on, let's say, November 30th. Let's use that as the example determination date. And so you would be looking at where those employees are located, whether they're located in any countries where foreign data privacy laws would prohibit disclosure of non-U.S. employee compensation. You'd be looking at how those employees that you had identified as of November 30, looking at how they're compensated, what elements of compensation do they receive, and looking at how their compensation data is tracked, whether or not you have third-party payroll vendors who keep track of this information. Maybe if you're dealing with a workforce that consists solely of U.S. employees, you might just be looking at W-2 data for your workforce. So that's what this profile would help you narrow down as far as the universe of information that is that the company has regarding its employees. The next step would be to choose the compensation measure that you would use to identify who your median employee is. Now, you could either use total compensation, which would mean base salary and wages, tips, commissions, bonuses, equity awards, basically everything that you would throw into a summary compensation table disclosure, or because we're talking about compensation for your workforce, which if you recall back in 2007 when we were first looking at how to prepare the summary compensation data as we know it today for our named executive officers, that was a challenge in itself. So the SEC understandably realized that trying to have a company put together summary compensation data, table data for all of its employees would be something of a challenge. So it was an accommodation to companies to allow them to choose what many are now calling consistently applied compensation measures. And so when you're choosing a consistently applied compensation measure, it could be something as similar as base salary, could be base salary plus bonus. The idea behind choosing a consistently applied compensation measure is to choose a pay element or a combination of pay elements that is representative of how the company's workforce is compensated. So if you're talking about maybe you only grant equity to your executives or to your officers, but generally the way that your workforce is compensated is through base salary and cash bonuses, then you would be able to choose what I would call annual cash compensation, base salary plus bonus, as your consistently applied compensation measure. So let's say that that was what you were going to choose as your consistently applied compensation measure. What you would do is try to pull that data, whether it's W-2 data or maybe you have other internal records that you use to keep track of how your employees are paid. And what you do is you can rank your employees from lowest to highest, or rather maybe instead of ranking, I should say, you can order your employees from lowest paid to highest paid based on this compensation measure of base salary plus bonus. And let's say you had a workforce of 101 employees, then whoever is number 50 in that ordering of lowest to highest paid, that's your median employee. And so then once you've identified who that median employee is based on that consistently applied compensation measure, then at that point you would then proceed to calculate that median employee's total annual compensation as if you were going to include them as a named executive officer in your company's summary compensation table. So last September, the SEC had issued some guidance because there were a few, I guess you could say, gray areas after the final rule came out that caused companies to question whether or not, for example, what kinds of records they could use in order to compile the compensation data that they would need to identify their median employee, or what should we do because the pay ratio disclosure is included with the executive compensation section in the 10K or in the proxy statement, and that's considered filed information, and what do we do if there is if we can take into consideration the idea that, well, there's extra liability that can be that can attach to filed information versus furnished. And then there was also a provision in the final rule that prescribed a specific test for determining whether or not an employee was or rather whether an independent contractor or at least employee counted as an employee for purposes of figuring out who your employee population was. And just taking a step back and looking at the first bullet on this slide, the rule is used to prescribe this one test where you would look at whether or not the company itself was whether it was negotiating a compensation arrangement with an independent contractor or whether or not the company was basically setting this person's compensation without any room for negotiation, whether or not there was how much control was being exercised by the company as far as how the independent contractor, or rather how the individual was performing their tasks and things like that. And it was essentially a brand new test for determining whether or not a person was an employee who should be included in the company's employee population for calculating pay ratios, or whether or not this person was an independent contractor under the pay ratio rule who could be excluded from this process for calculating and preparing the pay ratio information. So it actually caused a lot of confusion, I think, and it caused companies to have to take a look at try to gather additional information as far as how the negotiations had gone for setting the pay rates for these people who may or may not have been independent contractors. So when the SEC had issued its guidance last September, they heard these comments and these questions that had come in from the companies about this independent contractor test, and they issued some relief and said that the company could actually use whatever employment or tax law tests that they had been using in the past in order to identify their independent contractors, and rely on those tests that the company had used in order to identify which individuals could be excluded from the employee population as independent contractors. I think that was a good result. I think it makes sense as far as allowing companies to leverage whatever analyses and data that they had used in the past without having to spend for any extra expenses as far as trying to gather the data to look at these past compensation negotiations with these independent contractors. And it was also, I think, a nice give, because you wouldn't want, or I don't think anyone would want this pay ratio disclosure or this pay ratio process to sort of muddy the waters, at least for maybe IRS purposes or tax purposes, as far as the classification of employees and independent contractors. So it was a nice give all around, and I think that for folks who maybe, or companies who maybe came to preparing their pay ratio disclosures or starting the process to prepare their pay ratio disclosures after this guidance came out in September 2017, at least they didn't have to spin their wheels and try to apply a new test that ultimately, at least in my opinion, didn't really do much for the company's bottom line. The next bullet is we focus on the fact that the SEC in their interpretive guidance confirmed that companies can use internal records that reasonably reflect annual total compensation, even if those records do not reflect every element of the employee's compensation. And so ultimately, I think what this guidance was aimed at was there was a concern that maybe W-2 information wouldn't be able to pick up equity award grants that had been made in the year. And if, in fact, equity grants were a common or a widespread or widely paid element of compensation for the company's workforce, then there was some concern that maybe W-2 records couldn't be used in order to identify who the median employee is. And so this interpretive guidance actually I think it laid to rest those concerns, and also it also helps companies that have employees that are not just in the United States, but dispersed throughout the world. And so if you're dealing with companies, or rather if you're dealing with payroll vendors and maybe internal records, and you had to try and figure out a way to compile the data, it's a way, this guidance lets you rely on the several databases of your payroll vendors plus any internal records that you may have as well. So it's another way to, I think, ease the path toward preparing this disclosure for your proxy statements. And finally, the last bullet on this slide is intended to address the concerns of those who are who are thinking about the executive compensation disclosure and this pay ratio disclosure being considered filed information versus furnished information. This is because of the process that we go through in preparing the pay ratio, and we're identifying an employee population as of a certain determination date, we're estimating or using we're estimating the employee's compensation as we're working toward identifying that median employee, because if we're not using total annual compensation and we're using a consistently applied compensation measure, then you're using a workaround that the SEC has given you in order to identify who this median employee is. So at the end of the day, this pay ratio disclosure, which has a number of assumptions and estimates built into it in order to prepare this disclosure, at the end of the day, it's an estimate. And so companies, I think rightfully, were concerned about potential investors or other readers of their proxy statements and 10Ks perhaps thinking that the pay ratio information or the median employee compensation information that was being provided in this part of the disclosure was an exact number. So in order for us to get a little bit of comfort on the filed versus furnished and potential differences in liability, in order to get a little bit of comfort on that, the SEC had said that they would not object if a company were to include disclosure in their proxy statement or in their 10K that says that this pay ratio is a reasonable estimate that had been calculated in accordance with 402U of Regulation SK. Which this brings us to the what I like to call the what do I need to do, what is nice to have versus what do I have to have in this pay ratio disclosure. So here's what you have to have. You have to include your annual total CEO compensation, and you have to include the annual total compensation of your median employee. You need to include a ratio comparing those numbers. So, for example, if you were to say something along the lines of the ratio of the CEO's total compensation to median employee compensation is 40:1. You could say it that way. You could say, although perhaps not the best way to put it, but another way to say it in narrative form, it would be to say, for example, that the CEO's annual total compensation is 40 times higher than the total compensation of your median employee. Other data points that you would disclose or that is required to be disclosed in the proxy statement or in the 10K include the determination date that you had used, what consistently applied compensation measure you had used to identify your median employee. So if you had decided that you were going to look at your employee population as of November 30th, and that you would identify your median employee based on base salary and bonus, then those are data points that you would disclose in your 10K or proxy statement. If you take advantage of any data privacy or de minimis exemptions in scoping out your employee population, you would disclose that you are relying on these exemptions. I've been to a few conferences in the past few months talking about where people had asked whether or not other companies were going to be taking advantage of the data privacy exemptions, and right now it seems like the consensus is that most companies would not be using the data privacy exemptions. The word around or at least the word being spread by these other companies is that they were able to get anonymous information. So their employees in these other countries where perhaps the data privacy law was in play, these companies were able to get the compensation information of the employees, but it had been, I guess one way to put it is the employee names were held back so that you could assign a code number for each employee and still get the individual employee data. So the data privacy exemption didn't seem to be one that other companies were going to be using. I can also see a potential setback later on if a company were to say that they were using or they were able to exclude employees from a particular country because data privacy laws in effect in that country would prohibit them from relying on or disclosing that information publicly. But then you can run into a setback later on if another company had employees in that same country and but was able to find a way to include that data later on. It just creates, I think, a little bit more of a headache as far as that data privacy exemption is concerned. And so if there were any other assumptions or estimates or adjustments, like a cost of living adjustment that the company had used in preparing its pay ratio disclosures, we would also have to disclose that in the 10K or in the proxy statement. All of this being said, the scuttlebutt at these conferences is that a lot of companies and their advisors are leaning toward taking a minimalist approach to this pay ratio disclosure, at least for the first year. They're looking at maybe approximately 2 to 3 paragraphs. And I think the reason behind that is it's going back to that tension between filed information versus furnished information and whether or not it's prudent to include additional information that could perhaps be fodder for litigation later on or perhaps SEC comment. So, so companies are taking a minimalist approach and they're going to, I believe they're going to try and limit their disclosure to those items that had been identified as required under Regulation SK. And so the next step would be to think, okay, well, if we're going to include optional disclosure, what can we include? Should we use perhaps a supplemental, should we provide a supplemental ratio that maybe compares the CEO's total comp to that of the other named executive officers, or maybe to the executive officers as a group? One thing to bear in mind if you're going to provide supplemental or additional ratios is once you provide extra information, you become you become locked in later on for future years in preparing that disclosure, and so it can raise questions later on if you were to stop providing supplemental information. A couple of things that I would recommend including would be to take advantage of that SEC guidance that allows companies to say that the pay ratio is a reasonable estimate. I think something else that bears disclosure or is worth disclosing would be to say that in light of the assumptions and adjustments and estimates that are relied upon in order to prepare this disclosure, an apples-to-apples comparison from one company to its competitor or its peer is not exactly useful or possible because each company is going to could be using a different assumption. They could be using a different determination date. They could be using a different consistently applied compensation measure. They could be applying cost of living adjustments. And so in that sense, an apples-to-apple comparison is actually, at least I think it's worth saying that those kinds of comparisons would not be useful or possible. And so then that sort of brings us, at least in this slide, to maybe one of the last questions about disclosure, which could be, well, where should we include this disclosure? And so some folks have considered whether or not the CDNA, the compensation discussion and analysis, is a proper place to include this pay ratio disclosure, and I would say that it's probably more prudent to move it out of the CDNA unless it was something that the Compensation Committee had considered in setting 2017 compensation. Perhaps instead of including the pay ratio disclosure in the CDNA, it would make more sense to include it in the narrative following the summary compensation table, where we would be describing the various elements and compensation arrangements that the company has with its named executives. So not only will we have various stakeholders reading our proxy statements, but with this pay ratio disclosure, but you may have employees who are reading it as well. Although there was a recent conference where someone had admitted that they had asked their employees who knows what a proxy statement is and what it discloses, and they got a lot of blank faces in their audience. So this sort of begs the question of you may have employees who, if they read the company's proxy statement or SEC or other public disclosures, they may ask about the pay ratio. They may ask about the median employee compensation that had been reported in the proxy statement. Employees may be comparing their compensation to the median employee compensation that had been disclosed, and they may have questions. And so one of the gating items, I suppose you could say, as far as employee communications go, is should we be including a copy of the proxy statement or an internal announcement about pay ratios or other Q&As on the company's intranet in order to be proactive in answering potential questions from employees. And the counterpoint would be that, for example, that company where they perhaps got some blank stares from their employees when asked about the company's proxy statement, perhaps the alternative to consider would be not to include the proxy statement or the 10K disclosure or an internal announcement on the internet, but perhaps to prepare some plain English Q&As or some talking points for the top line managers to have in their back pocket in case any questions come up, so that they're not taken by surprise if they do get asked that question, but on the other hand, maybe keeping a low profile with this disclosure. A couple of things that may be worth including in these plain English Q&As would be to explain what a median compensation means as opposed to average compensation, and to explain that the disclosure relies on estimates and determination dates and other adjustments that vary from company to company, and maybe it makes more sense for your top line managers to be aware of or be prepared to speak toward the company's philosophy or policies as far as how they would compensate other employees outside of the officer ranks, and how they plan to be competitive and how they execute on that strategy as far as the compensation goes of their employees. One thing to keep in mind if you prepare Q&A summaries or talking points is to perhaps have your outside counsel or your legal department review it. Depending on what information is included in those talking points, they may be considered additional soliciting materials that should be filed with the SEC. An extreme example, I suppose, would be if a company were to disclose a pay ratio that got a reaction from investors or the press, and the CEO were to say that in light of this reaction, for 2018 compensation, I would rather be paid in, or have my compensation be changed so that it's more performance-based, or maybe it's heavier in options versus cash or something like that, something that may cause the CEO's compensation to change. In that case, if you had a say-on-pay vote in that particular year, it might make sense to file additional soliciting materials, and if it involves the CEO, then file an 8K describing this change so that the company can stay in compliance with its other securities reporting obligations. And then finally, this brings us to the investor viewpoint slide and the pay ratio information and how that's going to, or how that may or may not influence in voting from your institutional investors during this 2018 proxy season. During a recent conference, there were representatives from BlackRock, T. Rowe Price, and Vanguard, large well-known institutional investors who had confirmed that pay ratios would not factor into their votes regarding re-election of compensation committee members or votes for or against say-on-pay during the 2018 proxy statement. One other thing is that ISS and Glass Lewis also confirmed that the 2018 pay ratio disclosures would not impact their vote recommendations for the 2018 proxy season. So at least for this first year of disclosure, it's a little bit of a wait and see. This pay ratio information is really more of a single data point that is surrounded by a lot of other executive compensation information that is being reviewed during the 2018 proxy season. Next year, in 2019, if this pay ratio rule hasn't been repealed, you may see investors or proxy advisors perhaps doing year-over-year comparisons to see how the pay ratio had changed. But for now, at least for 2018, we can breathe a little bit of a sigh of relief in knowing that these pay ratio numbers are not going to influence votes for director elections or say-on-pay. And then one other thing to recall is that if you do have one-on-one conversations with BlackRock or another investor who would like to get additional context around your pay ratio disclosure, just remember that one-on-one conversations can lead to potential Regulation FD footfalls, and you'll want to be mindful of the information that you share with them during these discussions. So that brings us to the end of the formal presentation on the pay ratio roundup. At this point, we'd like to share with you the code for to get CLE credit to be filled out, to be included on your affirmation form. The code is 18369. And if you need a copy of an affirmation form, please email Susanna Kamaj. Her email address is susana.camaj@bakerbots.com. And so at this point, I see that a few questions had come in from the attendees on this webinar, and so let's try to address those before we sign off today. So the first question that came in is how to treat temporary employees. And if an employee served for only part of the year, whether or not that person's compensation can be annualized. So for temporary employees who are employed on the determination date, they do need to be included in your employee population. Understood that sometimes it's not as easy as being able to say that we only hire seasonal employees, for example, who may only be employed by the company during the holidays in December, and so maybe it's not as easy as picking a determination date outside of that period. So if you do happen to have temporary employees, you can annualize their compensation. But if they're paid at a part-time rate, the catch is that for those employees whose compensation you're annualizing, you can't do it in a way such that it makes their comp look like they had been paid at a full-time rate. And I think the SEC's position on that was such that they were concerned companies may try to make their ratio look a little bit better if they can make it look like their median employees' compensation was higher than it was. So yes, you can annualize the compensation, but be mindful of the fact that if it's someone who is working for 3 out of 5 days out of the week, that you're not calculating that annualization to make it seem as if that person was receiving 5 days of pay in that 1 week. The annualization would be should be consistent with that 3 days a week wage rate. And then as far as there's a question on when incentive awards should be considered to be widely issued. And some color that we can add there is that when you're choosing what your consistently applied compensation measure is, it should be one that does a reasonable job of estimating what your employee's compensation is. And so if you're dealing with, let's say, equity awards, which are only granted to officers, then that's one way to say that, well, the equity award portion is really limited to a subset or a much smaller subset of the employee compensation and can't generally be considered as a means to estimate how employees are compensated on a total comp basis. The idea is to come up with a measure that is universal enough to say that this is how we generally compensate our employees. The other thing to bear in mind is if let's say you pay cash bonuses to your employees and everyone gets a 10% cash bonus, whether or not you include that cash bonus in your calculation for identifying your median employee, that 10% bonus doesn't really, I guess you could say, it doesn't really move the dial too much once you start getting to narrowing down who your median employee is, and maybe you've got 2 or 3 who are in that, right in that middle spot. And so it's as much a judgment as anything else, where you're looking at whether or not that 10% is something that would be consistent year over year, or maybe that 10% bonus that everyone received that particular year was just a one-off thing that was only going to happen that 1 year. And so at the end of the day, what we're focused on for incentive awards, whether we're talking cash or equity, is whether or not including or excluding that particular element is going to blur the picture on how the companies are company's employees are generally compensated. So if it's equally accurate, I suppose you could say, to focus on base and cash bonus and say that those are two elements that everyone receives, then you can use that as your consistently applied compensation measure. But on the other hand, if equity is something that's universal from the top down, then it's not necessarily going to be, it's not necessarily going to be the best approach to exclude equity awards from that consistently applied compensation measure in order to identify that median employee. So really it's more a matter of looking at what's the best combination of pay elements that we can say is generally paid or granted to our employee population in order to be able to identify which measure should be used to identify that median employee. And so we have a few more questions that came in. One more question, if a company has a mid-year CEO transition, would the ratio refer to the incoming CEO's part-year compensation versus the median employee's full-year compensation? And so there are a couple of ways to handle mid-year CEO transitions. One way to do it is to look at who the CEO was on the determination date and calculate your ratio based on that information. The other way to do it would be to calculate the outgoing CEO's compensation that he had received through his termination date and add that to the compensation that the new CEO would receive from his commencement date through the end of the year. And that's a situation where you may end up with unusually high CEO compensation, or rather an unusually high pay ratio, and that would be an example where it would be good to provide additional context to explain why the pay ratio would be maybe higher than one would expect. And it would also be a good opportunity to explain how you had calculated that pay ratio to begin with, and to explain that you had either looked at the compensation of the CEO as of the determination date, or you had added the two CEOs' compensation together to reach that pay ratio. And so I think that takes us to the end of our time. At this point, if there are any lingering questions, feel free to reach out to me. My email address is beverly.reyes@bakerbots.com. And thank you all for joining us today.